Hey everyone, and welcome back at Talk Tickers. Today we're breaking down Wells Fargo's fourth quarter 2024 earnings call, ticker symbol WFC. You guys sent over your notes and that massive transcript, but we're here to cut through all that noise and give you guys the insights that actually matter.
Exactly. We're going to decode the jargon, connect the dots, so you can walk away with a clear understanding of not just the numbers, but also what they mean for Wells Fargo and maybe even your own investment strategy.
All right, let's jump right in. Headline news, Wells Fargo closed at $75.95.
Not bad.
Yeah, a solid 6.69 jump for the day.
Why?
Well, their Q4 report dropped and it's packed with good news. They blew past earnings per share estimates.
Wow.
And net income is up 11% year over year. Color me impressed.
It's a strong performance for sure. What I think is really fascinating is their approach. It's diversified. They've successfully balanced growth and fee-based revenue with disciplined expense management. And this is what helped them navigate the dip in net interest income we've been seeing as interest rates fall.
Okay, so they're not putting all their eggs in one basket. Got it. But what really caught my eye is this credit card explosion they've got going on.
Oh, yeah. This is where things get interesting. Since 2021, they've rolled out 11 new credit card offerings, bringing in a whopping 2.4 million new accounts. And get this, credit card spending surged by over $17 billion.
Wow.
This strategic move is clearly paying off, and it's a segment worth watching closely.
It's like they're quietly becoming a credit card giant right under our noses.
Precisely. And while they're building this credit card empire, they're also laser-focused on efficiency.
Okay.
They've been trimming headcount every quarter since Q3 2020.
Interesting.
This laser focus on cost has allowed them to pump more resources into key areas like technology and customer experience.
So they're streamlining operations, making strategic investments, and seeing strong results.
Not bad.
Right.
Not bad at all.
Yeah.
And there's more good news.
Oh.
Remember all those consent orders Wells Fargo was grappling with?
I do, yeah.
Well, it seems they're turning the corner on that front, too. The OCC just terminated a major consent order related to their past sales practices.
That's a big deal. Does this mean they're finally free and clear to move forward?
It's a significant step towards rebuilding trust and operational strength. This allows them to operate more freely and focus on growth, which is exactly what they seem to be doing.
And let's not forget about the shareholders. They've been showering them with capital. A 15% dividend increase and a massive $20 billion in stock buybacks. That's a clear vote of confidence in their future, wouldn't you say?
Absolutely. And looking ahead to 2025, their outlook is cautiously optimistic. They anticipate net interest income to grow between 1% and 3%. Modest loan growth is also on the cards, fueled by those booming credit card and auto businesses, as well as expansion in their corporate and investment banking division.
Okay, so we've got the big picture. But for those of us who like to dig into the nitty-gritty, let's break down their fourth quarter performance in a bit more detail. What stood out to you?
Well, let's start with net interest income. It actually saw a slight uptick, increasing by $146 million, or 1% compared to the previous quarter. This marks their first linked quarter increase since Q4 2022.
Interesting. So even with falling interest rates, they managed to squeeze out some growth there.
Exactly. One factor was their higher customer deposit balances. This meant they could rely less on pricier market funding, which helped boost their net interest income.
Smart move. Now, what about loans? Did those follow the same upward trend?
Unfortunately, no. Average loans were down from both the third quarter and a year ago. However, the fact that their net interest income still grew despite this decline speaks volumes about their ability to manage deposit costs and funding sources effectively.
That's some impressive financial maneuvering right there. Now let's shift gears to non-interest income. Any bright spots there?
Absolutely. This segment was a star performer, showing robust 11% growth year over year. This can be attributed to a combination of their strategic investments and some favorable market conditions.
So it's not just one thing driving this growth, but like a perfect storm of strategic planning and market tailwinds.
Precisely. And the beauty is that this growth wasn't confined to just a single area. All of their operating segments contributed to this impressive year-over-year surge in non-interest income.
That's always a good sign, right? Having multiple engines driving growth makes them less vulnerable to setbacks in any one area.
You're absolutely right. Now let's talk expenses. Did they manage to keep those under control?
Well, their expenses were actually a tad higher this quarter. Total non-interest expense rose to $13.8 billion, up from $13.6 billion in the third quarter.
But hold on. Before you hit the panic button, This increase was mainly due to higher operating losses, which were largely driven by customer remediation accruals related to a previously disclosed matter.
Ah, I see. So it's not necessarily a reflection of their underlying cost management efforts.
Exactly. If
Yep.
you exclude those operating losses, their expenses were actually pretty much flat compared to the third quarter, which is a good sign considering they're still investing heavily in growth initiatives.
That's reassuring. So they're keeping a tight rein on costs while still positioning themselves for future growth. Exactly. It's a delicate balancing act, but it seems like they're managing it effectively.
Okay, so expenses are under control, growth is diversified, and they're making strides on the regulatory front.
Right.
But what about the elephant in the room? Credit quality. Any signs of trouble brewing there?
Actually, no. Their credit performance has been remarkably stable.
That's a relief to hear. What's their net loan charge-off ratio looking like?
It held steady year over year at 34 basis points. However, it did climb slightly by 4 basis points from the third quarter.
Okay, so a small bump, but nothing too dramatic. What's behind that slight increase?
It was mainly due to higher charge-offs in their commercial real estate office portfolio and their credit card portfolio.
So those are the areas to keep an eye on. Anything else on the credit front that we should be aware of?
Well, their allowance for credit losses actually dipped a bit from the third quarter, which reflects the overall stability in their credit trends. So they're not anticipating any major credit shocks on the horizon. That's good news. But what about their capital and liquidity position? Are they on solid ground there?
Rock solid. Their common equity tier 1 ratio, or CET1 ratio for those in the know, stands at a healthy 11.1%.
Okay, that's a mouthful, but what does it mean in plain English?
Simply put, it's a measure of a bank's financial strength. And 11.1% is well above their regulatory requirement, meaning they have a comfortable capital cushion to absorb any unexpected losses.
So they're sitting pretty financially speaking, and they're clearly feeling confident about their financial strength, considering they plowed another $4 billion into stock buybacks in Q4, bringing the yearly total to a whopping $20 billion.
That's a clear signal to the market that they believe their stock is undervalued. They're putting their money where their mouth is.
All right, so we've covered the overall picture. Now let's zoom in on their individual business segments, starting with consumer banking and lending. What were the key takeaways there?
Well, their consumer, small, and business banking segment saw a 7% dip in revenue year over year. The main culprit. You guessed it, those lower net interest income figures we discussed earlier. Customers are shifting their deposits to higher yielding products, impacting this segment's performance.
So it's the same trend affecting their overall net interest income, just playing out in this specific segment as well. Any silver linings within consumer banking and lending?
There is a glimmer of hope. The pace of this deposit migration has actually been slowing down, which suggests the trend might be reaching its peak.
Fingers crossed. Now, what about their home lending business? Were they able to buck the trend there?
Surprisingly, yes. Their home lending revenue actually climbed by 2% year over year. This was primarily driven by higher mortgage banking fees.
Interesting. So even though interest rates have been falling, they still managed to make some headway in home lending.
Exactly. Their retail mortgage originations jumped by 31% year over year, fueled by a combination of higher purchase volume and a temporary surge in refinancing activity earlier in the quarter when rates were even lower.
So it was a mix of market conditions and their own strategic efforts that contributed to this growth. All right, now for the segment everyone's buzzing about, credit cards. You mentioned they're doing phenomenally well there. Give us the numbers.
They posted a 3% year over year increase in credit card revenue.
All right, 3% growth. Not bad, but not exactly earth-shattering, right?
True. But it's the underlying factors that are truly impressive. Increasing loan balances coupled with higher card fees driven by a surge in point-of-sale volume were the main drivers behind this growth. And remember those new credit card products we discussed earlier? Well, they're clearly gaining traction and contributing to this positive momentum.
So it's a combination of strategic product launches and overall consumer spending trends working in their favor. That's encouraging to hear. Now let's switch gears to their auto business. Was it able to keep pace with this credit card success story?
Unfortunately, not quite. Auto revenue actually declined by 21% year over year.
Ouch. That's a pretty significant drop. What happened there?
It's a combination of factors. Lower loan balances, primarily stemming from previous credit tightening measures, and ongoing loan spread compression are the main culprits.
So it sounds like a bit of a tough environment for their auto lending business.
Mm-hmm.
All right, let's shift focus to their commercial banking segment. What's the story there?
Well, their middle market banking business witnessed a slight dip with revenue decreasing by 2% year over year, the primary driver. That familiar foe, lower net interest income, reflecting the impact of rising deposit costs.
It seems like those rising deposit costs are a recurring theme across their different business segments.
You're right, it's a challenge they're navigating across the board. However, there is a silver lining. They saw growth in treasury management fees, which helped offset some of that decline.
Okay, so a bit of a mixed bag there. Now, what about their asset-based lending and leasing business? How did that segment fare?
They faced a steeper decline in that area, with revenue dropping by 12% year over year.
Yikes. That's a significant hit. What caused such a dramatic decrease?
Lower net interest income and lease income were the main culprits, although improved results from their equity investments did provide some partial offset.
So again, a mixed bag with some bright spots, but also some areas of concern. Taking a step back, did their commercial loan balances grow overall?
No, they didn't. Average loan balances for the fourth quarter actually shrunk by 1% compared to a year ago.
Okay, so even though they saw some growth in certain pockets, their overall commercial lending activity contracted. What's the reason behind this decline?
Well, growth in their middle market banking business was more than offset by lower balances in asset-based lending.
So some internal shifts and portfolio adjustments were also playing a role in these numbers. All right, let's move on to their corporate and investment banking segment. How do they perform in that arena?
Their banking revenue in this segment took a 4% dip year over year.
Okay, another decline. What were the key factors at play here?
Again, we're seeing those familiar culprits, higher deposit costs and lower loan balances.
It's starting to feel like a broken record, right?
You're not wrong. However, this time, there's a particularly bright silver lining.
Intriguing. Tell me more.
This decline was partially offset by a surge in investment banking revenue.
Now, that's what I like to hear. What fueled this increase?
They saw increased activity in both equity and debt capital markets, along with higher advisory fees.
So despite facing headwinds in traditional lending activities, they're seeing strong momentum in their investment banking business. That's an interesting contrast.
Precisely. And their commercial real estate business? Well, that continued to face some headwinds, with revenue declining by 14% year over year.
What's driving that decline?
Primarily lower net interest income and lower loan balances as they continue to reduce their exposure to the office sector.
That makes sense given the ongoing challenges in the commercial real estate market, particularly in the office space.
Yeah.
But are there any bright spots within their commercial real estate business?
Well, they did experience a significant increase in debt capital markets revenue, reflecting their ability to capitalize on opportunities in the capital markets.
Okay, so commercial real estate faced some headwinds, but saw a glimmer of hope in the capital markets. What about their markets revenue? Was that able to stay afloat?
Unfortunately, no. Their markets revenue experienced a 5% decline year over year.
All right, another drop. What's the story there?
Lower revenues in equities and municipals were the primary drivers behind this decline.
So some specific markets are weighing on their overall performance in that area?
Exactly. However, their performance in most other fixed income products was stronger, which helped to partially offset these declines.
Okay, so it's a mixed bag yet again. Anything else noteworthy about their market's performance?
It's worth mentioning that their fourth quarter results were impacted by the implementation of a change related to funding valuation adjustments for their derivatives. This resulted in a loss of $85 million.
So an accounting adjustment that artificially skewed their reported results. It's important to keep that in mind when analyzing their true performance. Okay, let's wrap up this segment by looking at average loans. Did those increase or decrease overall?
They actually decreased by 6% year over year.
All right, another decline. What drove this trend?
Continued reductions in their commercial real estate portfolio, particularly in the office sector, were a major factor. They also experienced lower loan balances in their banking business as clients increasingly turned to capital markets for funding.
So it's a combination of strategic portfolio adjustments on their part, coupled with changing client behavior. All right, that covers their corporate and investment banking segment. Now let's turn our attention to their wealth and investment management segment. How did that segment fare?
This segment had a strong showing, with revenue surging by 8% compared to a year ago.
Now we're talking. What fueled this impressive growth?
Higher asset-based fees, primarily driven by increased market valuations, were the main drivers.
So they're riding the wave of the rising tide in the financial markets. That makes sense.
Precisely. However, there's one important detail to keep in mind. The majority of their advisory assets in this segment are priced at the beginning of the quarter.
Okay, interesting. Why is that detail significant?
Well, it means that their first quarter results will reflect market valuations as of January 1st, 2025. and those valuations were up from both a year ago and October 1st, 2024.
So potentially more good news on the horizon for this segment.
It's a reasonable expectation.
Yeah.
Now, shifting focus to deposits and loans within this segment, how did those perform?
Well, average deposits increased by 6% year over year, reflecting continued growth in client assets. And average loans grew by a more modest 2%, driven by higher loan balances in their securities-based lending and residential mortgage portfolios.
That's a positive sign. It indicates that they're attracting and retaining assets in this segment, which bodes well for their future growth prospects.
Now let's touch briefly on their corporate results. Any highlights to mention there?
Their revenue increased year over year, driven by improved results from their venture capital investments.
Now that's interesting. They haven't always had the smoothest ride with those investments, have they?
You're right. They faced some challenges in the past with impairments on those investments for the previous 2 years. But in 2024, they turned things around, seeing net gains every quarter, with performance notably improving in the second half of the year.
So a bit of a comeback story for their venture capital portfolio. That's a positive development that definitely contributed to their overall revenue growth. All right, before we move on to their outlook for 2025, I think it's time for a quick recap.
Agreed. There's a lot to unpack here.
Absolutely. So what are the key takeaways so far? What should our listeners really be focusing on?
First and foremost, Wells Fargo delivered a solid fourth quarter performance, exceeding earnings expectations and demonstrating strength in key areas like fee-based revenue and their burgeoning credit card business.
Yes, and they're strategically navigating the current interest rate environment, managing their expenses effectively, and even making strides in resolving those pesky regulatory issues.
Precisely. And they're clearly confident about their future, showering shareholders with capital through dividends and stock buybacks.
It's like they're sending a clear message. We're here to stay, and we're here to grow.
Exactly. Now, while they face some headwinds in certain areas, particularly in their auto and commercial lending businesses, they're also capitalizing on opportunities in other segments like investment banking and wealth management.
It's a dynamic picture with a lot of moving parts. But one thing's for sure, they're not standing still. They're actively adapting, evolving, and making strategic moves to position themselves for long-term success.
Couldn't have said it better myself.
Yep.
Now let's shift our focus to the future and dive into their outlook for 2025.
All right, let's do it.
They provided guidance on two key metrics: net interest income and non-interest expense. Starting with net interest income, or NII for short, they're projecting growth between 1% and 3% in 2025.
So modest but steady growth, even in this low interest rate environment. What are they basing this projection on?
Well, their guidance is anchored on several key assumptions. One is the recent forward rate curve, which factors in between 1 and 2 Federal Reserve rate cuts.
So they're anticipating further easing of monetary policy?
Precisely. And given their modestly asset-sensitive position, this easing will create a slight headwind for their net interest income.
That makes sense. Now, what about loan growth? What are their expectations for that in 2025?
They're anticipating modest loan growth from the fourth quarter of 2024 to the fourth quarter of 2025. They expect to see growth in their corporate and investment banks, market group, and banking activities, as well as their auto and credit card portfolios.
So a combination of corporate and consumer lending growth. And what about deposits? Any insights into their expectations there?
They anticipate modest deposit growth across all of their deposit-gathering businesses. They believe this growth will allow them to further reduce their reliance on higher-cost funding sources, which is a positive sign for their net interest margin.
That's a win-win. Anything else they're factoring into their net interest income guidance?
They're also considering the reinvestment of lower-yielding securities into higher-yielding assets. They're also assuming that their asset cap will remain in place throughout the year.
So it's a complex equation with a number of moving parts. But the bottom line is they're expecting modest growth in net interest income. Now let's turn our attention to their expense guidance. What are they projecting for 2025?
They're forecasting their non-interest expense to be approximately $54.2 billion in 2025.
How does that compare to their 2024 expenses?
It's slightly lower than their reported non-interest expense of $54.6 billion in 2024.
So they're essentially guiding for flat expenses year over year, even as they invest in various growth initiatives. That's impressive. How are they managing to keep expenses in check while still fueling growth?
Their ongoing efficiency initiatives are a major factor. They're projecting a substantial $2.4 billion in gross expense reductions in 2025 thanks to these initiatives.
That's a significant chunk of change. It seems like Their focus on streamlining operations is really paying off.
Absolutely. They're also benefiting from lower severance costs in 2025 compared to 2024.
Okay, so a one-time factor that's helping them keep expenses in check. What about their revenue-related expenses? Are those expected to increase in line with their revenue growth projections?
Well, they do anticipate a rise in revenue-related expenses within their wealth and investment management segment. They're projecting an increase of approximately $600 million in 2025.
So more expenses, but hopefully more revenue to offset them. What's driving this increase?
Primarily, it's due to their expectation of higher revenue in this segment, which will naturally lead to higher compensation costs.
This is a good problem to have, right?
Absolutely. It's a sign of a healthy and growing business.
What are they assuming for the growth in their wealth and investment management revenue?
Their outlook is based on the assumption that the S&P 500 index will experience modest growth from its current level.
So they're banking on continued strength in the equity markets to fuel this segment's growth. What about their other expenses? Are those expected to increase or decrease in 2025?
They're projecting a modest increase of approximately $200 million for all other expenses. This is a result of the impact of efficiency initiatives being more than offset by higher investments in other areas.
Can you give us some examples of these other areas of investment?
Certainly. They're planning to invest approximately $900 million in incremental technology expenses, including investments in infrastructure and business capabilities. They're also allocating another $900 million to other areas, which we'll discuss in more detail later.
Okay, so significant investments in technology and other strategic initiatives. And what about those pesky inflationary pressures? Are those impacting their overall expense outlook?
Yes, they're expecting other expenses like merit increases and performance-based compensation to increase by approximately $800 million.
So it's a delicate balancing act, managing those inflationary pressures while also making strategic investments for future growth.
Precisely. But remember, they're also expecting significant cost savings from those ongoing efficiency initiatives. They're projecting approximately $2.4 billion in gross expense reductions in 2025 due to these efforts.
That's a substantial amount of savings. They've been very successful in their cost-cutting efforts over the past few years, haven't they?
Yes. They've implemented over $12 billion in gross expense saves since they began prioritizing efficiency 4 years ago. And they believe there are still opportunities to become even more efficient.
So it's an ongoing quest for operational excellence. It's impressive to see them maintaining this focus on efficiency while simultaneously investing for growth.
Absolutely. It's a delicate balancing act that they seem to be managing quite well.
Now let's delve deeper into those investment priorities for 2025. You mentioned several key areas they plan to focus on. Can you elaborate on those for our listeners?
Of course. One of their top priorities is building a robust risk and control infrastructure. They're committed to investing in this area to ensure the long-term health and stability of their business.
That makes perfect sense, especially considering their past regulatory challenges. They're clearly committed to preventing history from repeating itself.
Absolutely. They're also investing heavily in technology and digital platforms to transform how they serve both their consumer and commercial customers.
It sounds like they're embracing the digital revolution with open arms. Can you give us some concrete examples of these investments?
Sure. They're continuing to migrate their applications to the cloud, transition to new data centers, and invest in data platforms to extract valuable insights.
So they're leveraging the latest technological advancements to optimize their operations and enhance the customer experience.
Exactly. They're also investing in artificial intelligence and machine learning to automate tasks, improve decision-making, and personalize the customer experience.
It sounds like they're leaving no stone unturned in their pursuit of technological excellence.
Indeed. They recognize that technology is crucial for remaining competitive in the ever-evolving financial services landscape.
Now, what about their investments in their core lending capabilities? Are they neglecting that traditional bread and butter business while chasing these shiny new tech advancements?
Not at all. They're continuing to upgrade their fulfillment and servicing systems, enhancing their private decisioning capabilities, and strengthening their fraud detection systems.
So they're making it easier and faster for customers to obtain loans while simultaneously bolstering their risk management processes.
Precisely. They're also investing in new lending products and services to meet the ever-changing needs of their customers.
It's encouraging to see them taking a holistic approach, investing in both traditional and emerging areas of their business. Now let's shift our focus to their customer growth initiatives, particularly in their consumer businesses. What's their game plan there?
They're planning to continue scaling their marketing efforts, modernizing their branch footprint, and increasing the number of premier bankers and financial advisors.
So they're not abandoning their brick-and-mortar presence, but rather adapting it to meet the evolving needs of today's customers.
Exactly. And they're complementing these offline efforts with robust online initiatives. They're focusing on enhancing their digital capabilities to make it easier and more convenient for customers to engage with them.
It sounds like they're embracing an omni-channel approach, seamlessly blending their online and offline presence to create a unified customer experience.
That's precisely their strategy. They recognize that providing a seamless and personalized customer experience is paramount for building loyalty and driving growth.
Now let's move on to their corporate and investment banking business. What are their investment priorities in that domain?
They're planning to continue hiring in priority sectors to drive growth in investment banking and capital markets. They're also expanding their coverage in under-penetrated markets and key industries.
So they're playing offense, taking a proactive approach to expanding their footprint and capturing market share.
Absolutely. And they're backing this expansion with investments in technology to enhance their trading and execution capabilities.
It seems like they have ambitious plans for this segment.
They do. They see significant growth potential in corporate and investment banking, and they're investing accordingly.
Now let's zoom out for a moment and assess their overall return profile. They mentioned their return on tangible common equity, or ROTCE, target of 15%.
That's right. They've made remarkable progress in improving their returns in recent years. Their ROTCE hit 13.4% in 2024, up from 8% when they first started outlining their return outlook in the fourth quarter of 2020.
That's an impressive upward trajectory.
Indeed, it demonstrates that their strategic initiatives are bearing fruit and they're generating solid returns on their investments in growth initiatives.
So they're not just chasing growth for the sake of growth, they're laser-focused on profitable growth.
Precisely. They're committed to creating value for their shareholders.
Now, before we move on to their risk profile and potential challenges, let's take a moment to acknowledge that the future is inherently unpredictable.
That's a crucial point. There are always external factors and unforeseen circumstances that can influence their performance. Some of these factors are within their control, while others are not.
Can you give our listeners some examples of the key risks and uncertainties they face?
Certainly. One significant risk is the ever-changing economic environment. A recession or a slowdown in economic growth could significantly impact their lending and investment banking activities.
That's a valid concern. What other potential challenges are on their radar?
They're also exposed to fluctuations in interest rates, as we've discussed earlier. Those changes can impact their net interest income and the value of their investment securities portfolio.
It's a constant balancing act for financial institutions managing interest rate risk. What else should investors be aware of?
Competition is another key consideration. They face fierce competition from other financial institutions, both traditional banks and those agile fintech disruptors.
That competition can put pressure on their pricing strategies and their ability to attract and retain customers in this dynamic landscape. What other external factors could impact their performance?
Regulatory scrutiny and changes in laws and regulations are always a looming concern for financial institutions.
It's a constantly evolving regulatory landscape that they need to navigate effectively. Anything else on the risk front?
They also face operational risks such as cybersecurity threats, data breaches, and fraud. These are serious concerns in today's digital age.
Absolutely. Protecting sensitive customer data and maintaining system integrity is paramount.
And finally, they face reputational risks, which can significantly impact their ability to attract and retain customers and employees.
Reputation is everything in the financial services industry. Building and maintaining trust is essential.
Precisely. So while their financial performance and outlook are promising, investors should always be mindful of these potential risks and uncertainties.
It's a great reminder that investing always involves a degree of risk, and due diligence is essential. Now, with that sobering thought in mind, let's lighten mood a bit and move on to our This Is Not Financial Advice segment.
Ah, yes. The moment where we unleash our inner Wall Street maverick and pitch an outrageous but plausible trade idea based on our deep dive into Wells Fargo's earnings call.
Remember, dear listeners, this is purely for entertainment purposes only. It's not investment advice, and you should always consult with a qualified financial advisor before making any investment decisions.
Absolutely. This is just us having some fun and exploring hypothetical scenarios.
All right, with those disclaimers out of the way, what's your crazy trade idea?
Given their aggressive push into credit cards and their stellar performance in wealth management, I'm contemplating a long-term play on a basket of consumer finance stocks.
Interesting. Which stocks would you include in this hypothetical basket?
Well, naturally, Wells Fargo would be a core holding, but I'd also consider adding other companies poised to benefit from the growth in consumer spending and wealth accumulation.
Can you give us some specific examples? Paint a picture for our listeners.
Think of companies like Visa, MasterCard, American Express, and maybe even some disruptive fintech players that are shaking up the traditional consumer finance landscape.
That's an intriguing proposition. It certainly aligns with some of the broader trends we're seeing in the market.
Indeed. But remember, this is a highly speculative trade idea. Thorough research and careful risk assessment are paramount before making any investment decisions.
Absolutely. We're not financial advisors, and this is not financial advice. We're just having a bit of fun exploring potential investment opportunities based on our analysis of Wells Fargo's earnings call.
That's right. And with that, let's wrap up part one of our deep dive into Wells Fargo's Q4 2024 earnings call.
They delivered a strong performance, beating earnings estimates and showcasing solid growth in key areas like fee-based revenue and their booming credit card business.
They're also making progress on the regulatory front, showering shareholders with capital and strategically investing for future growth.
We've covered a lot of ground, but there's still much more to explore.
Stay tuned for part two, where we'll delve deeper into their investment priorities, their long-term growth strategy, and their plans to navigate the ever-changing financial landscape.
Until then, thanks for listening to Talk Tickers.
Welcome back to Talk Tickers. Before the break, we left off talking about Wells Fargo's investment priorities for 2025. They're laser-focused on fortifying their risk and control infrastructure.
Yeah, that makes perfect sense.
Yeah.
Given their past regulatory issues, it's reassuring to see that they are prioritizing this area. They're clearly committed to preventing history from repeating itself.
Absolutely. They're investing heavily in compliance programs, bolstering internal controls, and leveraging technology to enhance their risk management capabilities.
It's like they're building a fortress around their operations.
Exactly. And while they're fortifying their defenses, they're not neglecting the need to innovate. They're
Right.
pouring resources into technology and digital platforms to revolutionize how they serve both consumer and commercial customers.
It sounds like they're embracing the digital revolution with open arms. Can you paint a clearer picture for our listeners? What exactly are these investments looking like?
Well, they're going all in on cloud migration,
Okay.
transitioning their applications to the cloud and moving to new data centers. They're also investing heavily in sophisticated data platforms to extract those golden nuggets of insight that can drive better decision-making.
So they're not just adopting technology for technology's sake. They're using it strategically to optimize their operations and enhance the customer experience.
Precisely.
Yes.
And they're not stopping there. They're also tapping into the power of artificial intelligence and machine learning.
AI and machine learning. That sounds pretty cutting edge. What are they using those technologies for?
They're using them to automate tasks, streamline processes, improve decision-making, and personalize the customer experience. It's all about working smarter, not harder.
It seems like they're leaving no stone unturned in their pursuit of technological excellence.
You got it. They understand that staying ahead of the technology curve is essential for remaining competitive in the ever-evolving financial services industry. Now, while they're embracing these cutting-edge advancements, they haven't forgotten about their core lending business.
Right, their bread and butter. Are they investing in that area as well?
Absolutely. They're continuously upgrading their fulfillment and servicing systems, enhancing their private decisioning capabilities, and bolstering their fraud detection systems.
So they're making it easier and faster for customers to secure loans while simultaneously tightening their risk management processes.
Exactly. And they're not just sticking with the status quo, they're also investing in new lending products and services to meet the evolving needs of their customer base.
It's encouraging to see them taking a balanced approach, nurturing their traditional lending business while simultaneously exploring new avenues for growth.
Agreed. Now let's turn our attention to their customer growth strategy, particularly in their consumer businesses. What's their game plan for attracting and retaining customers in this competitive landscape?
Well, they're planning to continue scaling their marketing efforts, modernizing their branch footprint, and increasing the number of premier bankers and financial advisors.
Right, so they're not abandoning their brick-and-mortar presence. Instead, they're adapting it to meet the needs of today's digitally savvy customers. It's all about striking that balance between the physical and digital worlds.
Exactly. And they're not just focusing on their physical footprint. They're also investing heavily in enhancing their digital capabilities to provide a seamless and convenient online experience.
It's like they're building a bridge between the physical and digital world, creating a unified and consistent customer experience across all channels.
That's a great way to put it. They're embracing an omni-channel approach, recognizing that today's customers expect a seamless experience regardless of how they choose to interact with them.
Yeah. Now let's shift our focus to their corporate and investment banking business. What are their key investment priorities in that domain?
Well, they're planning to continue hiring in priority sectors to drive growth in investment banking and capital markets. They're also expanding their coverage in underpenetrated markets and key industries.
It sounds like they're going on the offensive, proactively expanding their footprint and targeting new markets. They're not content with simply maintaining their existing position. They're hungry for growth.
That's a great observation. They're not just expanding geographically, they're also deepening their expertise in key industries. And to support this ambitious expansion, they're investing in cutting-edge technology to enhance their trading and execution capabilities. It seems like they have big plans for this segment.
They certainly do. They see significant growth potential in corporate and investment banking, and they're not holding back on investments to capitalize on those opportunities.
Now let's zoom out for a moment and take a look at their overall return profile. They mentioned their return on tangible common equity, or ROTCE, target of 15%. What's the story there?
That's right. They've made remarkable progress in improving their returns in recent years. Their ROTCE hit 13.4% in 2024, up from 8% when they first started outlining their return outlook in the fourth quarter of 2020.
Wow, that's a significant improvement. Clearly, their strategic initiatives are paying off, and they're generating impressive returns on their investments.
Precisely. They're demonstrating that they're not just chasing growth for the sake of growth. They're laser focused on profitable growth that generates tangible value for their shareholders. Now, before we delve into their risk profile and potential challenges, let's acknowledge that the future is inherently uncertain.
It's a crucial point. There are always external factors and unforeseen circumstances that can influence their performance. Some of these factors are within their control, while others are not.
Exactly. One major risk they face is the ever-changing economic environment. A recession or a slowdown in economic growth could significantly impact their lending and investment banking activities.
That's a valid concern. It's impossible to predict with certainty how the economy will perform, and any significant downturn could create headwinds for their business.
Right.
What other potential challenges are on their radar?
They're also vulnerable to fluctuations in interest rates, as we've discussed earlier. Those changes can impact their net interest income and the value of their investment securities portfolio.
Right. It's a delicate balancing act for financial institutions to manage interest rate risk effectively. What else should investors be aware of?
Competition is another key consideration. They face intense competition from both traditional banks and those agile fintech disruptors that are shaking up the industry.
Yeah, competition can put pressure on their pricing strategies and make it more challenging to attract and retain customers in this dynamic landscape. What other external factors could impact their performance?
Regulatory scrutiny and changes in laws and regulations are always a concern for financial institutions. It's a constantly evolving landscape, and they need to adapt quickly to stay ahead of the curve.
That's a good point. The regulatory environment can be unpredictable, and any significant changes could impact their operations and profitability.
Right.
Anything else on the risk front?
Well, operational risks are another key consideration. Cybersecurity threats, data breaches, and fraud are serious concerns in today's digital age. Protecting sensitive customer data and maintaining system integrity are paramount.
Absolutely. A single data breach could damage their reputation and erode customer trust.
Yeah.
And finally, we can't overlook reputational risks. In the financial services industry, reputation is everything. A tarnished reputation can make it difficult to attract and retain customers and employees.
Precisely. So while their financial performance and outlook appear promising, investors should always approach any investment with a healthy dose of caution and be aware of these potential risks and uncertainties.
Exactly. It's a great reminder that no investment is without risk, and due diligence is essential. Now, with that sobering thought in mind, let's inject a bit of fun into our conversation and move on to our This Is Not Financial Advice segment.
Ah, yes, the moment where we let our inner Wall Street maverick loose and pitch an outrageous but plausible trade idea based on our deep dive into Wells Fargo's earnings call.
Remember, dear listeners, this is purely for entertainment purposes only. It's not investment advice, and you should always consult with a qualified financial advisor before making any investment decisions. We're just two finance enthusiasts having some fun, and exploring hypothetical scenarios.
Right.
All right, with those disclaimers out of the way, what's your crazy trade idea?
Given Wells Fargo's aggressive foray into the credit card market and their stellar performance in wealth management, I'm envisioning a long-term play on a basket of consumer finance stocks.
Interesting. Which stocks would you include in this hypothetical basket?
Well, naturally, Wells Fargo would be a cornerstone of this portfolio, but I'd also consider adding other companies that are strategically positioned to benefit from the anticipated growth in consumer spending and wealth accumulation.
Can you give us some concrete examples? Paint a valid picture for our listeners.
Imagine a portfolio featuring industry giants like Visa, MasterCard, and American Express, complemented by a sprinkling of disruptive fintech players that are shaking up the traditional consumer finance landscape.
Now, that's an intriguing proposition.
Yeah.
It certainly aligns with some of the broader trends we're observing in the market.
Indeed. But remember, this is a highly speculative trade idea. Thorough research and careful risk assessment are paramount before making any investment decisions.
Absolutely. We're not licensed financial advisors, and this is not financial advice. We're simply exploring potential investment opportunities based on our analysis of Wells Fargo's earnings call.
That's right. And with that, let's wrap up part 2 of our deep dive into Wells Fargo's Q4 2024 earnings call. They delivered a strong performance exceeding earnings expectations and showcasing solid growth in key areas like fee-based revenue and their burgeoning credit card business.
They're also making strides on the regulatory front, showering shareholders with capital, and making strategic investments to position themselves for future growth. We've covered a lot of ground, but there's still more to explore.
In part 3, we'll take a closer look at their long-term growth strategy, their plans to navigate the challenges and opportunities in the evolving financial landscape, and we'll wrap up with some final thoughts and key takeaways for our listeners.
Until then, thanks for tuning in to Talk Tickers. We'll be back soon with more insightful analysis and engaging discussions on the companies and trends shaping the financial world.
Welcome back to Talk Tickers. We're wrapping up our deep dive into Wells Fargo's Q4 2024 earnings call. So far, we've explored their strong performance, strategic investments, and we've even brainstormed a few kind of out there trade ideas. But before we say goodbye, let's talk about the bigger picture. What's their long-term game plan? How are they navigating this ever-changing financial landscape?
It's a great question. Wells Fargo's leadership emphasized their commitment to sustainable growth during the earnings call. They're not just focused on those short-term gains. They're really trying to build a foundation for long-term success.
That sounds promising, but what does that actually look like? What specific steps are they taking to achieve this sustainable growth? Well, one key element is their focus on responsible banking. They're committed to supporting their customers and communities while also generating, strong financial returns for their shareholders.
So it's not just about profits. It's about making a positive impact as well. I like that.
Absolutely. They're also emphasizing innovation and digitization. They're investing heavily in technology to enhance the customer experience, streamline operations, and drive efficiency.
We talked about those tech investments earlier. It seems like they're really embracing that digital revolution.
They are, and they're not just focused on internal innovation. They're also partnering with fintech companies and exploring new technologies to stay ahead of the curve.
So they're not afraid to think outside the box and collaborate with others to drive innovation. That's a smart move in today's rapidly evolving financial landscape.
Agreed. Another key element of their long-term strategy is talent development. They're committed to attracting, retaining, and developing top talent to ensure they have the right people in place to execute their vision.
Right? People are the heart of any successful organization. It's great to see them prioritizing their employees.
Absolutely. They're investing in training programs, leadership development, and creating a culture that fosters growth and innovation.
So they're building a workforce that's equipped to navigate the challenges and opportunities of the future.
Precisely. Now, while their long-term vision is compelling, it's important to acknowledge the challenges they face.
Right. Every company faces obstacles. What are some of the biggest hurdles standing in their way?
Well, the competitive landscape is one major challenge. They're facing intense competition from both traditional banks and fintech disruptors.
We touched on that earlier. It's a crowded market, and everyone is vying for those same customers.
Exactly. And the regulatory environment is another challenge. The financial services industry is heavily regulated, and Wells Fargo has faced its share of regulatory scrutiny in the past.
They're still operating under that asset cap, which limits their ability to grow.
That's right. And they need to be vigilant about maintaining compliance with evolving regulations.
So it's a delicate balancing act, navigating those regulatory hurdles while also pursuing growth and innovation.
Precisely. And then there's the economic uncertainty. We're living in volatile times, and any significant economic downturn could impact their business.
It's a risk all financial institutions face.
Absolutely. But despite these challenges, Wells Fargo's leadership expressed confidence in their ability to execute their strategy and achieve their long-term goals.
They've made significant progress in recent years, transforming their business and improving their financial performance.
They have their company in transition, and it'll be interesting to see how they navigate the years ahead.
Well, I have to say, I'm impressed with what I've heard today. They seem to be addressing their past mistakes, making smart investments, and building a solid foundation for future growth.
Yeah, I agree. It's a compelling story, but it's important to remember that the future is uncertain.
Always good to have a dose of reality.
Exactly. But overall, I'm cautiously optimistic about Wells Fargo's prospects.
Me too. Well, I think we've covered just about everything. Any final thoughts before we wrap up this deep dive?
Just a reminder that this deep dive was for informational purposes only. It's not investment advice, and any investment decision should be made in consultation with a qualified financial advisor.
Absolutely. Always do your own research and seek professional guidance before putting your hard-earned money at risk. And with that, let's officially close the books on Wells Fargo's Q4 2024 earnings call.
It's been a fascinating journey exploring their performance, strategies, and future outlook. Hopefully, our listeners now have a deeper understanding of this financial giant and the factors that are shaping its trajectory.
Thanks for joining us on this deep dive into Wells Fargo. Until next time, keep those portfolios diversified and remember to always stay curious.
Happy investing!